Mr. Bismarck Rewane. He is the CEO of Financial Derivatives Company Limited, and of course, he is also an economist. Together, we will be reviewing the performance in the macroeconomy for 2014. Thank you, Bismarck, for coming.
Thank you, Bola.
On the program. We have to bring you out of bed too early.
Thank you. Happy New Year.
Same to you here. Okay, let's begin. First of all, let's take a general look at the economy for 2014 before we begin to look at the details as to what happened.
2014 can be divided into two equal halves. The first half is called stable and high. Things were stable. All the indicators were pointing positive. The second half was what we call rough and tumble. That's where everything turned down. And I picked that phrase from my good friend Fola Nike Ogulesi, who Bishop called rough and tumble. Okay.
Okay. Let's look into details as to what made it the first half to be stable.
Well,
and high.
Clearly, first and foremost, growth was at 6.23% GDP growth. Oil price was $108 a barrel. It peaked at $115 a barrel. The reserves were at $38 billion. The naira was stable at 155, and in power market it was it appreciated to as much as $169 naira to a dollar. Everything was positive but some other things happened. CBN governor got edged out. There was talk about $20 billion missing or not missing money. But generally speaking, inflation was 8.2%. And so all the and then with the economy based and styled the largest economy in Africa. Rebasing doesn't mean anything. It didn't mean that you grew. It only means that they use a proper scale to measure your weight. That was what it is. So that was those are the main issues that took place in
the first half
of the year.
The second half.
Second half, then everything started. First of all, we had a visitor called Patrick Sawyer, who came in from Liberia, and you know what happened. Nigeria was caught totally unawares. Then we started facing the oil price volatility. There was a massive sell-off of the naira. The Chibok girls were actually kidnapped in the first half, but then we had all the fallout of that process. But generally speaking, the naira started coming under pressure. And at the end of the second half, oil price had dropped by almost 48% to about $57 a barrel, from $116 a barrel in June to $57 a barrel yesterday. Our reserves came all the way down to $34 billion. The excess crude account has come all the way down to $2 billion, and in fact about zero now. Unemployment has peaked. So in all respects, the misery index, what you measure unemployment plus inflation, so it has political ramifications. People, for the first time in so many years, volatility in oil prices and the decline in government revenue is affecting everybody: government, corporates, and individuals. And that is why when 11 states were unable to pay salaries in December is a very critical period. We have a coincidence of Muslim and Christian holidays in this December, January. And 11 states out of 36 states cannot pay salaries. It's a pointer to the fact that is why we say for 2015, prepare for turbulence, financial turbulence, and fasten your seatbelts. That's our call for 2015.
Okay, what do you think the government did right in terms of macroeconomic issues?
In 2014?
Yes.
First and foremost, it was all tactical in the sense that they were able to maintain stability. Inflation was managed. In fact, in 2014, we had inflation decline for 3 consecutive months. After increasing for 6 consecutive months, it's come down to 7.9%, which is the lowest it has been for many years. They've been able to contain the reserves. The central bank was able to respond adequately in all cases to maintain. But there's nothing much you can do. If your income drops by 50%, then you need to do something. So putting the honest picture before the Nigerians, at the last MPC, the central bank put the honest picture before the Nigerians. The fiscal space, the president wrote in to say that using a benchmark price of, first and foremost, we're talking about 78, and then we went to 73, then went to 65, but now you can see that the benchmark price is now academic because the spot price is $56 a barrel. So it doesn't mean you can't have a situation where the roof is and the foundation, right? So that is what the spot price is always higher than the benchmark price. So, but circumstances have changed. So I think basically putting the economic issues on the table, being honest about it, and using these tools of economic management to ensure that you can actually respond will be the pass marks. But the things that have not been done properly are also significant.
Okay, let's talk about the plans to diversify the economy. What level of success do you think the government achieved for the year?
Well, economic diversification is a long-term issue. So the way to measure it is, if you see diversification today, it is not because of what happened today. It happened to things that happened 5, 10 years ago. So what efforts you make now, you will not see the effects for some years to come. So when people take credit for things that really didn't accrue to, which they didn't do, it's fundamentally dishonest. The reality is that what you see today, the effects of the steps that were taken in 2004, 2005, then you begin to see them. So fiscal policies manifest themselves over a long period. Monetary policies are almost instant. That's why if you take a decision on the exchange rate, you feel it the next day. When you take when you offer an incentive for people to invest, you don't feel it for another 5, 6, 7, 8 years. So when you talk about diversification, in Nigeria, it's all been rhetoric and no reality. Nigeria's oil dependence has actually increased in spite of all the speeches. You see that 75% of fiscal revenues are oil, and then export revenues are about 90%. LNG is another 7 or 8%. So non-oil exports, even though you hear of non-oil sector growth, when it comes to the value of how much in dollars it brings to the table, the non-oil exports are bringing nothing more than 5%. What you have that has come in is portfolio funds from hedge funds and other institutional investors from abroad. That's what we call hot money. And when those people started taking their money, that is what led to the precipitous drop in the stock market, because those are monies, those are liabilities. And when liabilities, the thing about liabilities to be repaid, are other people's money. So when you take credit for the fact that even there's stability, if you back out the hot money from the system, then you find that the reserves are not as robust as they are.
Let's talk about the valuation of the Naira, because I know that there are other issues surrounding the foreign exchange market, but the move by the central bank to devalue the exchange rate, was it a good move? And was it the only option the central bank would have explored in the course of the year?
Look, basically, the exchange rate is a price. There's demand for the product, which is dollars, supply of dollars. Once the demand is in excess of the supply, the thing to do is allow the price to adjust. The necessary and sufficient thing to bring equilibrium in the market. If they hadn't done that, you will find that the spread and the difference between the parallel market and the official market would have expanded to a point where there will be distortions to economic resources being allocated. So it was the only thing to do. But the point is not just whether you devalued. Was the devaluation enough? Was the dose of the medicine enough? At that time, yes, but it has a long way to go. The parallel market today is trading at 193. The question Nigerians want to hear in their room today is that, at what price am I going to be buying the dollar? Maybe in 2 months from today. Will it cross 200 naira? Yes, it will cross 200 naira in the parallel market. No question about that. But then it will stabilize. The exchange rate is not a sacrosanct. It's not written in gold. The Japanese yen is God knows how many 100 yens to a dollar. The euro is it started at 89 cents. 9 US cents to 1 euro. Today it's 121. It even went up to 1.46. So we shouldn't be obsessed with the exchange rate as it is. The point is that, is it stable? And can you make decisions based on that? Because investors want certainty and they want to have confidence. Then they will invest. If they invest, then productivity will increase and people will be happier. So what is important is to say that are people confident? Are people optimistic about the future? Right now, people are worried and anxious about what tomorrow brings.
I'd like us to take a look at oil prices because I know that according to the figure that we have here, it slumped by 48% to $56 per barrel, and that's the current price of that. And there have been projections that it could go below $50 per barrel.
It will go below 50.
Do you think that we could have actually taken that step to say, okay, let's tighten our seatbelt, let's buckle up and say, let's put this figure below $50? Would that have been the right decision by the finance minister?
It doesn't change anything. I mean, it would have been the right to have projected rightly. But what she said in a letter, the president's letter to the parliament, or to the National Assembly, was that there's volatility in the market. I'm going to come back to you. If the prices drop below a particular level, I'll come back and we'll cut back some more. But some people say, look, the best thing to have done is the lowest point and then climb back up.
Which do you think would have been the lowest point?
Well, it's difficult. Nobody knows. Don't forget that oil was $10 a barrel in 1999. Right? So it's not that it could go, our projection that it goes as low as 45 and then begin to come back up. Maybe in the last quarter of the year, it will get all the way back up to about maybe 65 or 70. But even you see that you're talking about 116 and all the way down. The point is that first and foremost, what did you do with the revenues you had when in the good years? And two, how prepared are you to make those adjustments and be honest about it? The thing is that we have difficulty because we are in the middle of an electoral campaign. And one of the questions we are going to deal with today is how much will the economics of this country determine the political outcomes? Yeah, and that's one of the issues. But from a policy-making perspective, what has happened is that today, our buffers, basically we have buffers to protect yourself against shocks, right? And that's why in cars you have shock absorbers. So if you go by a bump, you don't feel the impact. If the shock absorbers are bad, you feel the impact immediately and could actually throw you out. So we have, the external reserves are down to $34 billion. It covers only 5 months of imports. The excess crude account is down to $2 billion, or so roughly that. It used to be $22 billion in 2008. Our external reserves in 2008 was $55 billion. So when we had this shock in 2008, we were able to withstand it because we had enough buffers. But the buffers could either be financial buffers or could be infrastructure buffers. What has happened is that your reserves have actually depleted and you have not used that to build assets. You have not used it to build refineries, you have not used it to build power stations, So what has happened is that the cash has been taken to spend on consumption. So we have thin buffers, and so the adjustment required now has to be much stiffer and much stronger than it was in 2008.